Okay, let's unpack this. Welcome to the Deck Dive. This is where we take the information you provide us and really try to dig into what's going on underneath. Today, we're looking at the global financial markets. Specifically, the focus seems to be on bond yields, based on the source material you shared. That includes some excerpts from Global Markets and Yield Stability from Preti Capital, dated Monday, May 26, 2025.
That's right.
So, our mission really is to see how the financial world kicked off the week, according to these sources. And it paints, well, kind of an interesting picture, full of contrasts.
It really does. The day began with what the source describes as a kind of nuanced performance. You had
Uh,
tech stocks showing some initial strength.
Right, the AI buzz and all that.
Exactly. Things like artificial intelligence, digital infrastructure, that ongoing excitement likely gave it a boost. But underneath that sector optimism, there was definitely a layer of caution.
From broader global issues.
Yeah, global uncertainties. Geopolitical developments were mentioned specifically as weighing on sentiment.
And you could really see that caution, couldn't you? Looking at the major US markets, the data shows the benchmarks pulled back. The S&P 500, that's the big index of large US companies, it was down 0.67%.
Uh-huh.
The Nasdaq Composite, which is, heavy on tech stocks, saw an even sharper drop, down 1.0%.
Right.
And the Dow Jones, the 30 big industrial names, that dipped 0.61%.
So, despite some early talk perhaps of tech leading the way, the overall session for U.S. stocks ended up looking pretty defensive.
Yeah.
It suggests that maybe macroeconomic worries or perhaps just some company-specific things ended up outweighing that sector enthusiasm by the close.
But here's something I found really interesting in the source material. You look at those US index declines, but then the VIX, the volatility index.
Yes, the fear gauge.
Exactly. It measures expected market choppiness over the next 30 days. It actually dropped significantly, down 7.72%. Now, why is that noteworthy when stocks are falling?
Well, that's a key contrast this source really highlights, isn't it? A falling VIX usually means traders are betting against big, sharp swings or, sustained downside in the very near future.
So even with stocks pulling back on the day.
Right. Even with that pullback, the market, or at least the options market reflected in the VIX, seems to view this particular downturn as maybe temporary or perhaps sector-specific. It suggests it wasn't seen as the start of some major systemic sell-off that would justify higher volatility expectations.
Fascinating. So a dip in stocks didn't necessarily translate into fear about future dips, at least not according to this VIX reading. Meanwhile, if we look globally, the picture was quite
It
mixed.
already mixed.
The FTSE 100 in the UK, their main index, had just a modest decline, 0.24%. But Germany's DAX, their benchmark index, it actually surged, a solid 1.68% gain.
Yeah, that jump in the DAX really stands out, especially against the US and UK moves.
What would cause that?
Well, it could be tied to specific positive economic news, maybe, or strong company results coming out of Germany that day, or perhaps just, different investor positioning over there.
Okay. And, and Asia also saw pullbacks. Japan's Nikkei 225, Hong Kong's Hang Seng, the Shanghai Composite, all down, generally between about 0.16% and 0.24%.
So yeah, the global equity landscape was really a patchwork, a clear divergence between, say, the US and Germany, while Asia kind of tracked more with the US direction.
Complex.
It really underscores how all these different regional factors and sector dynamics were playing out at the same time. The source also touches on commodities and currencies briefly. Oil prices were choppy, influenced by Middle East negotiations apparently. Gold held steady, acting as a safe haven, and the US dollar showed resilience, though maybe tempered by questions about the Fed's next move.
Okay, let's shift gears a bit based on the source, because what really caught my eye was the section on the bond market. The source explicitly notes a relatively stable environment for key bond yields, a striking lack of movement today.
Yes, and this is really the core focus, I think, of this deep dive based on the material. We're given the specific numbers. The 10-year Treasury yield is sitting at 4.509%. The 3-month Treasury bill yield is at 4.09%. And the 30-year Treasury bond yield is at 5.031%.
And the key point?
The really significant point highlighted is that none of these yields budged. Zero movement on the day reported.
That lack of movement right across the curve feels pretty significant, especially when stocks are having a mixed to down day and you've got these global uncertainties being cited. What does that tell us? What's the bond market pricing in here?
Well, if we take the 3-month yield first, that one's highly sensitive to expectations for short-term interest rates.
Yeah.
It basically signals what the market thinks the Federal Reserve will do next.
Okay.
So at 4.23% and completely flat, the source explicitly interprets this as the market anticipating no immediate changes to the Fed's monetary policy. The bond market seems pretty confident the Fed is just staying put for now.
Right, holding pattern. And the 10-year yield, that's more influenced by medium-term expectations, right? Growth and inflation over the next few years.
Exactly. So the 10-year holding steady at 4.509% suggests that market expectations for those medium-term factors, growth, inflation, were also just locked in place on this particular day.
So nothing in the news moved the needle.
Apparently not. Investors just weren't seeing anything in the day's news or data that was compelling enough to shift their view on the general economic path or inflation pressures in the, say, 2 to 10-year time frame.
And finally, the 30-year yield. That reflects the really long-term outlook.
That's the one. At 5.031% and also flat, it indicates that the market's long-term expectations for growth and inflation remain anchored as well. So the stability across all these key maturities, short, medium, and long, it suggests a kind of consensus or maybe just inertia in the bond market about the fundamental economic outlook and the Fed's likely path. It's a picture of equilibrium, as the source puts it. Potentially just a period of absorbing recent information before any big shifts happen.
Okay, so let's try and put it all together from the source for today then. We saw a day of pretty nuanced market activity. You had that initial optimism in tech, probably linked to AI and similar themes, but that was set against these broader geopolitical worries. And this led to quite varied performance across the global indices. We saw declines in the US benchmarks, S&P 500, NASDAQ, Dow Jones.
Right.
But that contrasted sharply with a surge in Germany's DAX, while Asian markets also pulled back a bit. And
Yep.
interestingly, despite the U.S. market decline, the VIX, the volatility measure, saw quite a significant drop.
And critically, we looked at that striking stability in the key bond yields, the 10-year, the 3-month, and the 30-year treasuries.
Right.
That complete lack of movement gives us a really direct read on market expectations
Expectations about what?
about Fed policy, about inflation, about long-term growth. It suggests a moment of just holding steady despite all the other movements elsewhere.
So today's information really underscores how interconnected everything is, doesn't it? Global factors, sector performance, central bank expectations. They all weave together to create this complex picture.
Absolutely.
Which leads to maybe a final thought for you, the listener. Given this snapshot we've seen today, stability in yields, even amidst some stock volatility and ongoing global uncertainties, what does that tell you about where investors are really placing their bets, thinking medium versus long term?
Interesting question.
Are they just waiting, biding their time? Or are they maybe quietly confident about something that the stock market isn't quite fully pricing in yet? It raises an important question, I think, about reading beyond just the daily headlines, something to mull over.